Hello.
Hello, I hope that you are doing well. So this is Suzy and I'm Luis, and today we decided to come in the same room, like that this is more comfortable for us and for you for the presentation. So let's begin the presentation. A minute just for us to launch the presentations. Up, okay.
It's great.
Okay, I think
Okay.
that everything's fine now. So, welcome for our presentations today. So today we are going to talk about the optimal ESG portfolio, an example for the Dow Jones Index by Anatoly Schmidt. So, about the agenda of what we are going to do today. So we are going to make a quick summary of the articles. Then we are going to see the theoretical and empirical framework. Then the main findings of the articles. Then Suzy will talk about the potential limitations, the sustainable socio-economic system, and a quick conclusion. So about the summary. About the subject. So the study is on optimizing investments portfolio by integrating environmental, social, and governance ESG considerations into the mean variance theory of portfolio. The methodology is about extensions of mean variance portfolio theory by Schmidt and introductions of a new parameter, ESG strange gamma, to integrate ESG value. So the analysis focuses on a portfolio of 29 stocks from the Dow Jones Industrial Average, covering the period from 2015 to 2019. Two approaches are compared. So the first one is the traditional maximum Sharpe ratio portfolio, known as PE-MVP, and the second is a modified versions that use partial correlations, referred to as PA-MVP. Finally, a new performance matrix was introduced, the ESG tilted Sharpe ratio, or also known as SHESGM, and this matrix evaluates the effectiveness of portfolio in achieving both financial returns and ESG objective. So about the theoretical frameworks, so we have seen 15 equations, and those equations build an analytical frameworks for integrating ESG preference into portfolio optimizations, and they establish clear relationships between returns, risk, diversifications, and sustainable impacts, while introducing metrics tailored to ESG objective. Those 15 equations in the article structures the theoretical and methodological approach to integrating ESG criteria into the portfolio. So firstly, we have the classical equations from 1 to 4, and those lay the foundations of Markovitch means variance theory, MVT, including the calculations of risk, so sigma p squares, return, RP, and the Sharpe ratio, SH. Also, the risk aversions parameter lambda is usually selected to align with the investor decisions, allowing for either a minimum variance portfolio or a maximum Sharpe portfolio. So, as you can see on the slide, we have a lot of different parameters that has been explained. For example, gamma is the risk, lambda, sorry, is the risk aversions parameter, or RE are mean portfolio asset returns. But I'm not going to go into all details of the parameter because there are lots and everything is on the slide. After that, so we have the ESG extensions. So from the equations 5 to 7. So those equations adapt MVT by incorporating the portfolio ESG value through the ESG strange parameter, gamma, formulating the new ESG MVT optimizations functions. It's directly related to the constraints, so the equations 8 to 10, and those equations define practical rules for the portfolio, such as the sum of the weight, the long-only positions, and also the target returns. After that, we have the equations from 11th, 14th, which are the partial correlations, and those equations enhance diversifications by replacing classical correlations with partial correlations, and thereby refining the calculations of variance and risk. And finally, we have the most important equations, so the equation 15, which is the new ESG ratio. And this new ESG ratio is the ESG tilted share ratio, combines financial performance and ESG impacts, providing a comprehensive evaluations of portfolio. So it's a definitions and calculations of ESGM as a synthetic performance measures, and the unity in the parentheses of the equations is added for reducing SHESGM to SHM in the case when PESGV is neglected. Then you can see that the strength parameter gamma may be choose to maximize SHESHM. After that, so for the main findings, so about data, so a lot of data has been used for the article. So 29 DAG stocks from the period 2015 to 2019 have been analyzed, except one, so one DG, one constituents, so the Dow Chemical, for which price prior to its merger with DuPont in 2015 were not available, was excluded from the list. So about the methodology in the sources, so the sources from the MSC ESG rating are all from the website over there, and also the rating were mapped to a linear scale and normalized to a range of 0 to 1. And these ratings were mapped on a linear grid and a scaling factor was applied. And this step allowed to quantify and integrate ESG into the analysis. So for each DAG constituent, Schmidt used the ESG score average over the period, and he did not use the risk-free rate. And also, Schmidt estimated a partial correlations between the portfolio constituents in respect to return of the SPDR S&P 500 ETF. So about the main results of the articles. So firstly, we have a comparison at a 0 PESGV using the Pearson method. So when we are using the Pearson method, we can see that we have only 8 assets that have a rate higher than 0.1%, making the portfolio less diversified, we can say. After that, now, while using the partial correlations method, there we can see that all the 29 assets have a weight exceeding 0.8%, resulting in a better diversifications. So the effects of increasing PESGV is that as the ESG strength parameter gamma increase, both Pearson and partial correlations-based portfolio become less diversified. Also, in the same times, the maximum Sharpe ratio decrease, and we can say that this happened because the correlations between the Dow Jones Index constituents, total returns, and their average ESG score is very low at a number of 0.17. After that, so about the optimal ESG strength gamma. So for the DAG portfolio, the ESG strength parameter gamma, when this one is near to 0.005 yields, have a maximum value of the ESG tilted Sharpe ratio. Then we have a in-sample versus out-sample performance. And while partial correlations-based portfolio have a lower Sharpe ratio in sample compared to Pearson correlations-based portfolio, this does not imply that PE MVP would perform PA MVP out of sample. So we can say that PA MVP are more robust and diversified with a more stable weight over time, especially outside bear markets. So this is a lot of information, but we can conclude those results by saying that the study showed that partial correlations-based portfolio improve diversifications compared to traditional Pearson-based portfolio, especially at zero ESG strength. And however, as the ESG strength parameter gamma increase, diversifications decrease and Sharpe ratio decline due to weak correlations between returns and ESG scores. An optimal ESG strength, so when gamma is approximately 0.005, maximize the ESG tilted Sharpe ratio while also balancing financial performance and ESG goals. Also after that, we have seen that PA MVPs are more robust and stable over time, particularly outside bear markets, making them a better choice for sustainable portfolio optimization. So now I can let the floor to Suzy that will explain the potential limitations.
Thank you, Luis. So now we are going to talk about potential limitations of this solution, this report. One of the main limitations of this model is a strong dependence on ESG data. This rating can vary significantly depending on the methodologies employed. This creates uncertainty as to the reliability and consistency of the assessments used to construct the portfolio. Harmonization of ESG standards could alleviate this limitation. Another challenge is the limited availability of ESG data in the public domain. This restricts the length of time series available for analysis, make it all of simple results less robust. Improving access to and coverage of ESG data over time would enable better model validations. And finally, the complexity of the model relies on parameters such as the gamma coefficient, which require subjective choices. These choices can influence the results. And also, I want to add the fourth limit. This is the findings are based on a limited time frame from 2015 to 2019 and data source MSCE ESG ratings. So now we are going to talk about a precise strategy for a sustainable socio-economic system. This paper highlights an innovative model, the SHESGM, which combines financial objectives with ESG considerations, as Luis already said. This approach aims to resolve the often perceived dilemma between economic performance and sustainability by offering an integrating solution for portfolio construction. The results show that integrating ESG criteria into investment strategies can improve the transition to a sustainable socio-economic system. By aligning financial objectives with social and environmental ones, transformations take place. Reducing negative externalities, relocating capital to sustainable industries, and to encourage behavior in line with the Sustainable Development Goals. And finally, we have balancing finance and ESG. The SHESGM model provides a precise solution for balancing financial returns and ESG impact. Unlike traditional approaches, it shows that it is possible to maximize financial performance while respecting ESG criteria, thanks to a rigorous methodology. This enables us to adopt an investment strategy that meets the expectations of our stakeholders. Stakeholders as investors, companies, or civil society. And Luis, can you do the conclusion? Oh, sorry, for me before. So, the conclusion about this paper, this report, and the solution. So, we just seen the potential of ESG integration in financial strategies. With the SEESGM model to innovate in the construction of sustainable portfolios, and that meets stakeholder expectations by reconciling finance and sustainability. About the challenges and the prospects, we can see a persistent challenges, standardization of ESG data and complexity of models. And also the challenge about the enhancing transparency and the challenge to simplify methodologies. And finally, our key message about this paper, um, for us is a promising approach to contributing to a sustainable socio-economic system.
Thank you, Suzy. Thank you to you also for listening to us. And I hope that this big resume of these papers could help you to better understand the articles and also to have a better understanding overall of the article. So thank you again and
Thank you.
goodbye.
Bye
Goodbye.
bye.